and bonds. Why is that?
Yeah, that's right, Sarah. I mean, we made this call, I guess, 2.5, 3 weeks ago, and it's worked out. The first part of that rally was really just, positioning and sentiment kind of getting washed out. The 200-week moving average held. But in order to get further support for this rally, we feel like rates need to come down, okay? And so like today, 10-year yields are coming in. We're still too high, though, for stocks to really make that next jump above the range that Mike was just talking about. But we do think that tonight's election could be very important in that regard. Because it looks like the House will go the way of the Republicans. That means gridlock, probably less fiscal spending will be achieved. Maybe that's in the market. We think it may not be in the market, just like when we had the Georgia runoff after the 2020 election. That wasn't in the market and rates went up and we got more fiscal spending. So we think this is an interesting juncture. The CPI is important on Thursday, but we view that more as just an event that has to pass and come because, at the end of the day, we think inflation will be lower next year. The peak is in. It's just a matter of pace and timing. And to me, the CPI is just sort of this event that has to come and go. So it's really about tonight. As everybody's been saying incorrectly, we won't know the answers potentially for a couple of days, maybe even a week, because they got to count the mail-in ballots. But directionally, we like to set up here. As far as today's action, as I said, the rates market is behaving better. The dollar's weaker. And the breadth is good. The breadth is actually quite impressive and a nice offset to the damage that's been going on in the more speculative parts of the market.
Just want to challenge the political point right now, because I get it's conventional market wisdom to think gridlock is good for the market and good for ultimately the economy, rein in the fiscal spending, all of that. But do we really want, more standoffs over the debt ceiling on the brink of a potential default or government shutdowns or nothing getting done in case we go into a deeper recession?
Yeah, well, that's what we need to separate from this being a trading call versus our core view. So I completely agree with you that this won't solve our problems for next year, which is that we're still going to have to go through an earnings recession, and that's probably going to be kicked off in the fourth quarter earnings reporting period. So I agree with you. And ultimately, this is a trading call. We think it could be very important for bonds, which would then spark the next leg for stocks, and we'll see how it goes. We won't stick around if we feel like these things are going against us. But I totally agree with your conclusion that gridlock doesn't solve, the real problem for equities, which is going to be earnings next year, nor, as you rightly point out, if we go into recession, that may actually be a hindrance for the recovery. So, yeah, we're not out of the woods at all yet on the bear market.
Or it could be bullish because it could mean then the onus is all just on the Fed, as it always is, and they're going to have to pivot and completely ease because they're going to be the only form of stimulus. And the market likes that. So, Mike, what is your call? Because we're at 38.25, and I think you're in June 2023, 3,900. So are you still as bearish as you have been overall?
Well, like in a 12-month view, we've been saying this for a while. Like we're not as bearish as we were at the beginning of the year because we think the 12-month view looks better now than it did 8 months ago. The problem is the path, Sarah. We do think that ultimately this bear market will make new lows. So it's a treacherous path. Okay, like this year, we think it's been pretty easy just to have a bearish view and kind of ride it, and that's what we've done. Now it becomes more tactical. Now we have to be more cognizant of these bear market rallies. We're trying to not trying to capture every penny of the bear market, and understand that we want to get long again at some point. So we got to be, disciplined around that. We think below 3,400 is the sweet spot for adding, serious, investment asset risk. We felt like the trading rally at 3,600 was a good trade. Nothing's changed in that regard. That's our call. It's a trading call. We think ultimately we'll put the real money to work when we make that final low, probably sometime in the first quarter.
So bond yields have to come down, which a lot of people are looking for to buy stocks. And then there's the earnings expectations. And you have been saying that they're, still too high and not factoring in a likely recession, which is what we're facing?
Yeah, I mean, that's the second part of our, fire and ice call all year is that we had the inflation risk. The Fed took care of that or is dealing with it now. That was the derating. And now we have to deal with the impact of that tightening. That'll come through the earnings channel. And we think next year, could be 20% too high in terms of the consensus estimates. That's bottoms up relative to what we think ultimately will play out. Okay, now I don't care what you think the multiple should be. That's not in the stock market. Now, the good news is a lot of individual stocks have probably already discounted that, right? So it's been a really bifurcated market. And now we're finally, taking out the leadership. The big tech stocks are finally happening. We're seeing a rotation into other parts of the market. I think it's premature to make that bet that that's sustainable. But I like the signs of that, Sarah. I mean, I'll tell you this, what we always look for at the end of these bear markets is what's working at the end of the bear market, because that's what's probably going to lead us out on the other side. And that would be things like financials and energy, commodities, and also industrials. Those groups look quite good to us on the other side of this. And so we won't be dogmatic. We got to start putting money to work here over the course of the next 3 to 4 months. But, I want to make it perfectly clear. We don't think the bear market itself is over until these earnings estimates come down.
Well, I don't understand why they haven't come down. You're not saying anything new, right? We all know that we expect the terminal rate, as the market is pricing it now, to go above 5%, and a lot of tightening in a very short period of time. So why do you think the market has been reluctant to price in an earnings recession like that?
Well, some people would argue that we did, right? 3,500 is a pretty good level. And as I mentioned, a lot of individual stocks may have done that. My experience.
But to your point, the expectations haven't come down that sharply.
Correct.
If you look at earnings estimates, yeah.
That's exactly right, and that's sort of the art form of what we try to do is we've done this a million times over the last 30 years, it feels like. And what I want to tell you is that the earnings forecast in the out year always take longer to come down than they should. And part of that has to do with the way the estimates traffic company guidance. Companies have not really talked about 2023 yet, and until they do, these numbers can stay lazily stale. And that's what's happened. So we think that will rectify itself probably in the fourth quarter reporting season. Maybe we're being a little bit too precise about that, but that's what we think.
Mike Wilson, always appreciate it. I know a lot of people are following your calls.
Appreciate
so thank
it.
you for joining us. Mike Wilson is the chief